Right, let's look at the descending triangle, another one of my favourite positions. And I've taken the stock of Invest over here, and this again was in 2004. And what are we looking at with this? And what are the reasons why I like it? Well, first of all, once again, I'm a trend follower, so I want to see a trend forming. I'm looking for breakouts, I'm looking to react to prices. I'm not trying to work out where Invest and global investment stocks might be going. What I'm trying to do is say, right, where the money goes, that's where I want to follow. If price moves sharply in a particular direction, then I know that's where the money's going. That's why these type of chart patterns are good, because they give me tight risk management, and I'll explain that in a second. They allow me to have risk control and clear exit strategies, and have a reward to risk ratio very much in my favour. Okay, enough of the jargon. What does all of that mean in English? And how do we see one of these triangle formations? Well, the reason it's a triangle is because you've got descending highs. That's one high, that's another. You can draw a line there. You've also got a horizontal base. In other words, the point at which the price touches. What are we looking for? Well, first of all, we're looking for a price to break below this horizontal line. Now you'll say, well, wait a minute, it broke out there. It's not done with minuscule precision. We're traders, we're not academics looking at technical analysis, so we do it in rough and ready terms. That's the first point. The second point with something like this is, okay, if it breaks out, how do I know when to get in? Do I get in if it breaks a little bit? The problem is, how about this? Do I get in when it breaks a lot? Now what I would say with something like this is, again, I usually look for it to move below, make a 2 or 3 day low, and then move lower. Well, here, as soon as it goes below, it's made quite a big low, and it's moved even lower. Here you wouldn't have had a triangle, because you could have got the horizontal line, as you can see. So, with something like this, you would have an entry point, maybe at a 2 or 3 day low, and got in as it started moving lower, around here or here. It might be that you waited a day, because you really wanted it to trade beneath that horizontal line. Sometimes I like that. I'm very, very risk averse. In which case you might have got in around here, the 365 pence level. Well, that's the first point. We've targeted an entry point. Why is this position so good on a risk-reward basis? Well, where do we put our initial stop loss? Put our initial stop loss at a point where the price should not go if we're right. Sorry to keep on going on about this, but it's a drill in. Where should the price be if we're wrong? Well, it should be somewhere along here again, so it should penetrate through and go back above. That's when we know we're wrong, and we'd exit if it moves up there. By the way, while I'm speaking, don't forget, if you want to pause at any point, you can use the space bar on your keyboard. If you want to forward slightly or go backwards, use the arrow keys on your keyboard. So, as I've mentioned, how do we know that I'm wrong and we put a stop loss? Well, we put it somewhere above here, maybe at a 1 day high. You can see that they're quite spiky, so we might say, well, if it moves about 10% higher from this baseline, then I know I'm wrong and I need to get out. So that allows me to put a tight stop loss, because my risk is only going to be about 5 or 6 pence, maybe even less, maybe 4 pence. Well, that's fine, that's my risk. What's my reward? The reward is supposed to be this, where you set your profit target projection so you know that the risk to reward ratio is worth it when you place the trade, is you measure this distance, you measure the apex or pinnacle of the triangle up here to the base here, and you say roughly, how many pence is that? Well, it's about 70 pence. Then you say, well, if the price moves 70 pence from this base downwards, that's what your profit projection is, something like 325 pence, which is rough and ready what we got. It's, again, a rough and ready measure. It's not science. It's more just a general rule of thumb. So you say, well, my risk is about 5 pence. My profit should be about 70 pence, maybe even 50 pence, given that I won't get the bottom bit and I won't necessarily get the entry bit. I'll only get the meat of the move. That's worth it. That's a 10 to 1 reward to risk ratio. You fill your boots with those. So, risk is worth it, reward, and as I said before, the money management ROMs, then you know exactly about how to work out how much money to place on a particular trade. Bottom line rule, remember, stop loss should be such that only 1% of your overall funds are ever lost should this stop loss be hit. That still gives you a big healthy profit. What about moving your stop loss? Well, you move it to a 2 or 3 day high, and that should mean that you stay in for the bulk of most moves. And that is Invest and how to trade the reversing triangle over there.